Hey, everybody, Dougal's here, and we got a different kind of show for you today. First up, I'm going to give you a preview of some premium content that we have, and you can access that by getting our annual subscription on skippydougals.supercast.com. Again, that's skippydougals.supercast.com. You can go on there, sign up for the annual subscription, and you'll get this. But going to start off with a few minutes of a preview of that episode where Skippy and Dougals review our portfolios. And then going to follow up with some of your favorite clips that you told us that you really enjoyed from 2021. So it's going to be that preview and then a compilation episode from 2021. Really hope you enjoy it.
Dougal's Indicator.
Yep.
Yes.
We're going to the Dougal's Indicator. And I will say two truths before I go into the Dougal's Indicator.
Just two truths and a lie. So it's two truths and then the Dougal's Indicator. Hogwash.
This podcast contains the arguably witty banter of two friends, Skippy and Dougals, that like to debate about investing. The content is intended to be entertaining and for informational purposes only, not investment advice. You should do your own research and consult a financial professional before using any of the information in this podcast, and especially before investing.
I don't know why they're always singing that "It's the most wonderful time of the year" song in December, when it should be January, because, at least for me, rebalance time. I love these conversations.
You just tried to say January, and I don't know what that was.
January. No, see, because January, that's the time that everyone else lives. Like the people that are out there just doing whatever they do. January is when you're buying 100+ PE stocks. That's what January is.
If we're drafting the most wonderful times of the year, January is not even going to be in my top 6.
What about January?
That is a month that doesn't exist.
Fair enough. Anyway, I'm excited for the combo.
Oh, dude. Okay, so I prefaced it last week, but yeah, you're going to be terrified. And so let me give you a quick preview of some of the things that I'm going to do a deep dive on. An apparel manufacturing firm that manufactures uniforms, corporate identity apparel. I'm so excited. Another one, a vehicle towing and recovery equipment company. I mean, come on. Aren't you excited? No one else wants to buy this stuff except me. And mean reversion is going to happen. So I can't wait.
That's sexy.
Yeah, it really is.
That's sexy. I'm excited to learn more.
So the fun part about this is ever since we've been chatting, but especially on the pod, we have fairly opposite viewpoints of how to make money investing in stocks. And they're at two ends of the spectrum. So, but the fun part is we both believe that process is incredibly important, and we both lean heavily towards the quantitative approach of trying to remove the human decision-making element. So, Dougals, you want to give us a high-level overview of your strategy and kind of your approach, and then I'll do the same on my end?
Sure thing. So I have a model that I call Farfin because why the heck not? That's really the only reason why. I wanted a name for it. And it's what I call long trend momentum, which is different than typical momentum investing. Typical momentum investing looks at usually the last year max at stock performance. Sometimes it's only looking at the last few days, looking at 200-day moving average, but I look at a long trend. So I look over years, decade, kind of long performance or longer. And what I look for in the stocks are that they are both consistent in their market beating returns, and also they have strong current recent momentum. Recent, again, for me, is their 1 year, 3 year, 5 year, 10-year returns. That's what I call recent. So consistent over the long term and have recent momentum. They have to be at least 5 years public so they have some kind of data. But even if you are only 5 years public, it's pretty hard for me to buy you because it's just don't have enough of a track record.
Exactly.
But that's like the really high level. So because it has some momentum going for it, one of the reasons why Skippy says that it's an opposite approach is because those types of stocks are pretty expensive in a lot of times. They are considered growth in many cases, might have high PEs relative to the stuff that Skippy buys. So we're an opposite end of the market there, but that's the high level.
Yeah, but similar approaches. I mean, momentum is a strategy that has been proven to work over and over. And when I look at the academic research, again, let me just be smart about this. None of this is investment advice, and past performance is not a predictor of future returns. But for our fun, friendly conversation here, like that's why I respect the Dougal strategy, because I've seen a bunch of academic research that momentum can work, and in a lot of ways, yours is more rigorous because it's make sure it's not a short-term fluke, right? It's not just something that went crazy and crossed the 200-day moving average that you jumped in. It's more durable than that.
Yeah, so it's in it. We talk about psychology a lot. So the durability of it being long term matches my psychology quite well, because I have both through my professional life, I think, and just in how I am personally, I believe in this concept of flywheels, of businesses being able to create their own momentum and build off of a foundation to be able to persist in the long term. And so that's the mentality that I have going into this. So that's that. And want to say again, this matches my psychology, which does not fit many people's. It ends up being a fairly concentrated portfolio of what I will even declare overly expensive stocks, which is potentially dangerous, but it works well for me, works well for my psychology. I've back tested it, which back testing has all the caveats, 16, 17 asterisks. I've back tested it for the last 60 years, works quite well over that period of time, but past, not predictor of future performance, but it is a predictor of what Dougal's about to do.
Exactly. No, the psychology piece is a good thing. So when we talk about my strategy, I mean, I think the only way to classify it is deep value. The core of my quantitative screen is basically the foundation is built on chapter 14 of The Intelligent Investor, Benjamin Graham, right? And if you don't know Benjamin Graham, that's Warren Buffett's teacher at NYU, absolute legendary. People claim he created value. Sorry, yeah. Why was I?
It's the NYU NYU Spanish Harlem.
Columbia, of course. So I won't go into all the details, although I might when we talk individual stocks, Dougals. But it's just something that's looking for really safe stocks. Benjamin Graham lived through the Depression, watched his holdings fall apart, watched the country fall apart at that point. And when he came up with the strategy out of the Depression, he said, I'm going to find things that are super durable. So these have really low debt. They have a great current ratio, which is just current assets to liabilities, which means they're not going to be in financial trouble anytime soon. They have dividend histories of 10 plus years. They have growing dividends typically. They have growing earnings. Like it's just these really stable, solid companies. And the fun part about looking over history is you can go back to 2007, 2008 and see how these companies weathered financial storms. And in the large majority of the cases, the stuff I'm buying went through that period just fine. And so they're just undervalued. They're not exciting, like I mentioned, but it fits my psychology really well. Like you mentioned, like I just like a deal. I've always liked a deal. So that's the breakdown. Now, Dougals, you mentioned the 60-year back testing. How about give me some a more near-term performance when you've actually had money on the line with your strategy?
Well, I mean, let's not discount the go-go years.
The what go-go
when I wasn't born. Let's not discount the go-go years when I wasn't born.
Let me tell you, I'm breaking down the strategy right now. In 1963, it was amazing. Right now, it doesn't work anymore. But
yeah, it's from October 15th to December 11th of 1964. This was beautiful. All right. So if you want to look at some more recent model performance, I'm going to break down. How about, because this is the way that my brain works. I could go 1 year, 3 year, 5 year, 10 year, fairly arbitrary, but that's like the way it works. So in 2021, so last year is 17.81% is what the model kicked out.
Oh, we're going 2 digits now. Come on, Dougals. Like,
okay, sorry. All right, 18%. I'm gonna round up.
Oh, look at you.
Round up.
Liar over there.
Right, yeah. So last year, 18%. When I look at my benchmark that I look at is, as I've mentioned, it's VTI. So it's a Vanguard Total Stock Market Index, which was about 26% last year. So last year it did not meet the benchmark. It's like give or take 65-70% of the time it does beat the benchmark. The rest of it doesn't. And so 1 year doesn't necessarily do that for me. It doesn't do anything for me, but that was 1 year. 3 year, 165%, 5 year, 185%, and the 10 year is about 658% cumulative return. Those are not annual returns.
Yeah,
Those are-
I was
those are
gonna say, do you have
cumulative
annual? Because the cumulative is like
I do.
hard for
I know,
me
but the
to-
cumulative it's so big. I got triple
it
digits.
sounds.
I got
Oh,
triple digits.
whoa, look at this.
Yeah, I know. Do you want average or median?
I mean, are they
Yeah.
that different? You tell me.
No, they're not, but it's just fancy. I guess I could throw out the Kager. I just didn't calculate that for this, but it's close enough.
yeah.
It's close enough. So I can do that right quick if you want me to. But the median over the last 10 years is 20%.
Okay. Yeah. Kager, compound annual growth rate or return, is better. So it's so funny you mentioned that 60 to 70%. When my model works, and historically, like in the back testing, my model outperforms an index, although I typically use the S&P 500 60 to 70% of the time. But in the last 5 years, I've underperformed more frequently than that. And I think that's simply because the markets have been going bonkers. And so a value strategy like mine isn't really meant to keep up with the markets when they are high flying. There's kind of a conservative nature built in.
22%
My
Kager.
returns.
22%
Oh.
Kager.
Look at you. So I'm going to talk last 12 years because that's what I have handy. My Kager would be 18.4.
Solid.
So look at you, Dougals. Last year I did 24.8. I'm going to round up too. Sorry, 25, which underperformed S&P 500. I have S&P 500 at total return at 28.71 to go 2 digits on you. And then I'll just, so people are kind of in the loop, I think I'll do some year-by-year returns over the past 12 years. So we go 36%, 11%, 13%, 22%, 9%, 8%. In 2016, had a big year, 57%. And then 17, I was at 17%. 2018 is the only year that I've had money in the strategy where I lost money. I was down 10%. And then 2019, 35%. Last year, 11%. And this most recent, 2021, 25%.
Nice, man.
It's good stuff.
So I just have VTIs, not S&P on me. But one thing actually that's important that you mentioned is all of these are total return. Like, so it's inclusive of dividends. I reinvest dividends back into the stocks that I have, but regardless, inclusive of dividends. The VTI's Kager over that time period was 15%. So that's nice. You take even like in either case, right? 3% a year over that long period of time is fire, fuego.
Yep. And if you can do it in a way where you never feel like you're going to lose your shirt, I mean, that's the main thing for me is I'm trying to limit drawdowns and everything else. My strategy's been interesting recently in terms of I'm kind of hovering near the benchmark. And then I have a huge year, right? I have a year of 30+% or 50+%, and that helps you run away from it. And then it seems like the rest of the time I'm kind of hanging near. I'm either 10% above or 10% below the benchmark.
And that is it's a big deal when you talk about the drawdowns piece. Drawdown being when you take the last like high point of the portfolio to whatever the trough is for like a given year. That's an intra-year drawdown. And I have like really significant drawdowns. And so my strategy does not limit drawdown so much, but it does have pretty high flying points. And I'd say overall, like in annual, it's intra-year drawdowns that are big. Annual drawdowns aren't that large necessarily, but there's some swings in these stocks because a lot of the times these are stocks that when you get to market conditions like we have today that are priced for near perfection. And so it's like the wind blows in the middle of Kansas and people are like, whoa, hold on, maybe 100 PE isn't a good idea, type of stuff. And so so you get intra-year swings that are pretty much.
Well, yeah, I think that's inherent with your approach and the flywheel. Like when the flywheel's going in your direction, things are probably climbing much more quickly than my picks could ever dream of gaining value, but it can spin the other direction as well.
Yeah. And especially where my psychology starts to get a little more tested are in market conditions like this, because this is, can I bring up, and I'm going to look this up so I get the quote exactly right. But there was a quote from Skippy once that called what I'm about to talk about hogwash. Yep. I got that quote exactly right. Hogwash.
We're going there. Dougal's indicator.
Yep, yes. We're going to the Dougal's indicator. And I will say two truths before I go into the Douglas indicator.
Is this 2 truths and a lie? So it's 2 truths and then the Douglas indicator? Hogwash?
That's gold star. If we were in second grade right now, that's gold star. So the 2 truths are, first truth is this. What I'm about to talk about with the Douglas indicator has shown strong correlation with market tops over the last 50 years. That's one.
Yeah.
The second is that you cannot predict market tops. Those are 2 truths. Okay.
I love it.
So with that, what the high level of Douglas indicator, for those that did not listen to episode 1 or episode 2 of last year, is that I look at overall market performance and then market performance relative to all of the equities basically that are traded out there. So that's a very high level look. And I look at how those perform next to each other. There's some derivatives and whatnot that go into that to make it fancy. And when I say, I don't mean financial derivatives. I mean, look at the change, the rate of change, right? Of how that shifts. And then I just looked at how that's performed. And there seem to be rates of change that occurred at times where there were market tops. So specifically when this has gone off the last 50 years was 1973, there was a 1973, 1974 significant drop, 1987, which had that crash, the year 2000 and 2008. Those are the last few times that it went off, right? The reason I say that market conditions like this are when it tests my psychology is because right now where the indicator sits is the same place that it sat in like between 1998 and 1999. It's like halfway between where those 2 years were.
Ooh,
it's the way that
it's kind of guessing that 2023 might
or it could be
the
next
correction.
Year. It depends. It depends because it could jump broadly.
I see.
It's also where it was in 2007. It's where it was in 1986. Like, so it's like, it's at that point where who knows, right?
The indicator is saying it's
getting
expensive.
There. Yeah.
Okay.
Things are expensive. And that's a time where my stocks, especially, we'll get into more detail here, but when I say highly concentrated, my top 2 holdings are roughly 65-70% of my portfolio.
You're
right?
scaring me over there, man.
Whew, I know, but it gets me tingling is what it gets me. So living on the edge. Who said that? Somebody said it. Aerosmith or somebody. So anyway, so the Douglas indicator is saying like we are in a period that is similar-ish to other periods that we've seen like this before. And you shouldn't ever just look at one thing, but we've talked about all the other indicators out there. You can look at Buffett's indicator. You can look at all of this stuff. It says like we're in some kind of a broad period. Who knows what's going to occur? But because it did not say that this is a bubble pop year, I bought stuff. And so I'm involved. I'm still bullishly pessimistic.
That's so good. I was on the edge of my seat for that Douglas indicator. I can't wait. You're telling a good story there.
To be honest, it's a little. I was so hopeful that thing was.
You wanted it to hit, yeah.
I really did because I'm scared. I'm like, oh, this market is it's out of control.
I'm scared too, man. And when we talk about what I'm buying, one of the things, the only thing I'm really debating right now is how much safety to build into it, and I'll probably do that with long-term bonds. But let me reset. This is a great point to do this. So we are rolling out 2 premium subscription options for a couple of reasons. One, we heard some people wanted to support the show, and we also heard that people wanted to hear about our portfolios. Obviously not investment advice, but we wanted to provide those options. We also didn't want to sell ads to Fidelity or Wealthfront or whoever else and come across as biased folks. So we're doing this for fun. Those premium subscription options are available. We had some subscriptions come in this week, which is awesome. Thank you guys. They're available at skippydougals.supercast.com. So there's like a monthly subscription option, $7 a month. That allows you to get the podcast earlier than everyone else and kind of become a supporting member of the family here. And then there's premium subscription. It's called Premium Plus. It's I Roll with Skippy and Dougals. That's a yearly subscription plan, the way it's structured right now. And that will allow you to get the breakdown of our portfolios and everything else, which is what we're going to jump into next. Dougals, did I miss anything on that front?
Nailed it.
Boom. All right. You want to start with, let's see. I got more stocks. I should probably start with my picks over here, right?
Yeah, you start off.
Okay.
All right. That's the preview. Reminder, go skippydougals.supercast.com And you can sign up for our annual subscription to be able to hear that full episode, get the rest of what we talked about there. Now on to what you told us were your faves for 2021. Enjoy it. Before you go on, though, would you explain what performance-based fees are?
If I manage your money and you lose money, or I make you 2%, I don't charge any fee whatsoever.
But both of those sound like plausible scenarios if you're managing my money. Continue.
Oh, please. Buffett either, but I could be wrong.
Let's just say it was Einstein, because why not?
It's like too witty for Buffett. Buffett would have had like 2 more sentences in there.
Yeah, exactly. He doesn't go that pithy. But when I heard this recently, and there's going to be some tension in the room right quick. When I heard this recently was when Chamath said it.
Wait, are we going to play this clip?
People, if you could see my textual messages this week, it was every 15, sometimes every 17 minutes. I'm getting something from Skippy to Doodah that's basically saying, I cannot believe this. What is this? What is he saying? Right? About value investing. Because Chamath this week said many, many things. Right. But one of them is he said, it's not timing the market, it's time in the market. And he spit some hotness.
Hold on. I'm going to play 30 to 40 seconds of this. Okay, here we go.
One of the most interesting things that's happened in markets in your professional career is this shift away from what I'll call value investing towards what I'll call growth investing. As a capital allocator, I'm just curious how this has looked from your seat. What to you looks absurd about the value investing style? Obviously, I would characterize you as a growth investor just based on how fast the companies that you've invested in tend to be growing. What concerns you or worries you about growth? Can there be too much of a good thing? What are the excesses that would cause you to be concerned? Just talk me through these styles, because you've been an exemplar of the change.
Let me answer this by asking you a question. Do you have 2 or 3 kids?
2.
Okay, 2. Are your kids valuable? Do they have value?
Of course.
How much value do they have? Infinite value. Fair?
Sure.
You wouldn't say that they're valuable because they cost $4, right? I think that the biggest fallacy of value investing is that people are not willing to revisit that word from first principles.
Okay, this is just hot garbage on 1,000 fronts. So one, you hear Patrick O'Shaughnessy. Did you hear that laugh? Go back and listen to that laugh. His family's worth $40 million because his dad understood. He wrote a book called What Works on Wall Street. Pioneered a lot of the factor investing stuff. They fully understand and support value investing. This is a freaking joke. So, okay, first of all, he says, "Are your kids valuable?" Yeah, of course your freaking kids are valuable. Are we investing in kids? No, absolutely not. What we're investing for, it has a quantifiable, there's a quantifiable goal here. So Dougal's, what makes a good investment? What, at the end of the day, what should your investment do for you?
Make money.
Yeah, right. So let's talk about cash flows. Okay. Let's not talk about revenues, profits. Let's not talk about any of this other crap. Let's talk about free cash flows. If you have free cash flow, what can you do with it? You can spend it, you can take it out, you can do whatever the hell you want. So if I'm an investor and I buy a company and it has free cash flows, that's freaking fabulous. The investment I made this week, and this is not advice, is TDS, Telephone Data Systems, price to free cash flow at 1.49. Okay. You know, Chapman's portfolio, he invested in Slack and some other nonsense. You know what price to free cash flow on Slack is? 200. All right. Who's getting a better deal here? Who's getting more cash flows? Me or him? Now, listen, if I can already see the look on your face, if this is a Series A and I'm the first person that Slack ever pitches, yeah, do I get a better deal on that? Maybe. And do I understand growth investing that you're saying, hey, 5 years from now or 2 years from now, Slack's growth is going to crush TDS's growth? Absolutely. But right now, I got 150 times better value than him per the price I'm paying for free cash flows. And it doesn't matter. 1 second, Douglas. It doesn't matter if I'm paying $4 for this.
Double done.
Right? Doesn't matter at all, because that company is worth $2 billion. I'll pay $2 billion for it. I don't care how many shares are out there. I don't care what's divided by. I don't think he's this naive. I think he's simplifying the conversation. But what he described is not value investing at all. It's not about $4 a share at all.
Wow. Hot fire.
I can keep going.
The difference in my mind is because I would say I mostly I'm not maybe I go too far to say agree, because you will hop in your car and show up here like those demon twins on SNL. I don't know if you watched SNL last week, but if people have not seen that clip, go watch the demon twins.
Watch what you say right now, because I will be at your house in no time.
The thing is, I think he's talking about valuable companies versus value investing. I think that's the difference. And you even when you're talking about your Hooker Furniture or your Kimball International or your TDS, right? You're not talking about valuable companies. You were talking about investments that are valued at a level in which you believe you're going to make money in the future. And that's different. And that's actually not what he's talking about. But he's saying, like, if something is valuable, then own it.
I mean, no, if something is valuable, then own it at a price. Like, I wrote this whole thing 6 months ago about Howard Marks breaking down, like, basically the price you pay matters. All value investors, go back to Buffett, go back to anyone with a brain, say the price you pay matters. And so both those companies are valuable. Like, pick your favorite company in the world. Amazon is incredibly valuable. Amazon is a company I would love to hold. Amazon at current prices is not going to give me free cash flows that are desirable in my eyes. TDS is. So to say that a company like a dirt cheap stock is not valuable is a joke. There are free cash flows there. Of course it's valuable. I'm not buying dumpster fires that lose money.
One thing that you just said makes me think about I'm going to overblow this a little bit, but the Michael Burry feud that is now going on between he and Cathie Wood, because you just said the hedgehog doesn't understand how cutting edge this is, right? What was Cathie Wood's reaction when Michael Burry came out and said that he was buying put options?
Let's reset. So Michael Burry of Big Short fame with the Michael Lewis book and movie, who basically called the housing crisis and made tons of money because of it. He now runs Scion Capital Management, and he recently has started betting against ARK Investment, who's run by Cathie Wood, and she's been mentioned on the show previously in crypto conversation, a lot of conversations. Douglas likes to call her portfolio a YOLO trip to nonsense, but if you're not familiar, she bets on cutting edge technology, and so her stocks are high flying momentum stocks that are very expensive in terms of metrics like P/E ratios. So when the news comes out that Michael Burry, I can never say his name, bets against her portfolio, her response, I don't have the tweet in front of me, Douglas. Should we pull up the actual tweet?
Yeah, let's pull up the tweet. So she says, to his credit, Michael Burry made a great call based on fundamentals and recognized the calamity brewing in the housing/mortgage market. I do not believe that he understands the fundamentals that are creating explosive growth and investment opportunities in the innovation space. What is the innovation space? Just to be clear, so Cathie Wood is imploding right now. I'm not even saying that her funds are going to implode. I'm saying that she seems to be, via social media, imploding right now. I state that because some of the things that she's saying are what you say when you are actually somewhat desperate. And I don't see her in day to day, but there must be something under the hood, because there was something else that I saw her say. She came out and said, we could not be further from a bubble.
Yeah, that's not a fact. That's not fact.
that is not, like, every piece of evidence. No, nearly. I shouldn't say every.
Yeah.
There's so many pieces of evidence that show that we are in bubble territory. That doesn't mean it's going to pop tomorrow. That doesn't mean it's going to pop next year, any of that. But there's so much to say. We couldn't be further shows me that you don't understand what a bubble is, first of all.
Well,
and that scares me.
I don't think it's that she doesn't understand. I think I hate, like, throwing shade or talking ill of people, but Douglas is giving me a look. But no, like, she's protecting her wallet, I would say. Like, she can't go around saying we're in a bubble, because that would that would be a reason to short her funds, which is what smart people like Michael Burry are doing.
Yes. I actually, no, I can't say yes. So I get what you're saying, and I lean into that. I think that the reason that I state that she's imploding is because, per what you said, she can't go around saying we're in a bubble. Fully agree.
Yeah. Yeah.
However, when you say we can't be further from a bubble, that's not saying we're in a bubble. Like, she's trying to, and from what I see, it feels like, I don't know her, I don't actually know what she's trying to do, but it sounds like she's trying too aggressively to state how safe things are, that there must be some, like, duck looks calm over the water, but underneath is getting buck wild. That has to be going on. These statements are not of someone of like sturdy ground.
Yeah, if I'm armchair quarterbacking this, she probably just feels threatened because more and more people are shorting her investments all the time. That's not a fun place to be. And if I was in a similar spot, we're going to talk about some of my investments coming up soon. Maybe I'll be claiming we're not in a bubble, depending on the hate mail that I get. All right.
Like, I know I don't mean to. Well, I guess I can't say I don't mean to throw shade, because that's probably exactly what I'm doing. But
let's kindly throw shade, though.
Yeah, she's in a pickle right now. You're right. I mean, someone's coming out with an ETF that is shorting an individual portfolio manager, right? Like, that's a pickle. Michael Burry, who has a lot of respect, right, in areas like this, is buying tens of millions of dollars, right, of put options against you. Like, that is a position where she has to feel really vulnerable, and she's down this year so far, not by a heck of a lot, but she's down in a time where the market is up double digits. Like, that's not a good position to be in. So I'm sure she's getting a lot of emails from investors, and feels like she has to come out and say some stuff. It's just that if I were her PR person, I would say that seemingly desperate statements isn't the way to do it, but saying things like there's more room to run. Say how much you believe in the stocks, and state that, and don't make platitudes about explosive growth in the innovation space, which exactly, I don't know what industry that is. I haven't seen the SIC code for that. All right. Anyway, sorry. I'm not throwing shade.
You just went sick code on me. Oh my goodness. Wow.
Where you can invest to get return. But I hadn't thought about where Tina exists, like when she just like strides around town, strutting her stuff in various areas of the market, right? And the impact that then has on the economics of even those micro environments.
Well, and your girl she's set up shop at the mobile home park, man. That's where she is.
Wild, what she
and so to connect this, I really want to make sure I'm articulating this well, because I just think it's so fascinating. To connect this to other conversations we've had going for the past several months, like, this is also part of the BlackRock buying suburban homes and stuff, because these investment firms are looking for places to create yield, and there's just everything's so expensive that they're going, oh, hard assets, real estate, oh, mobile home parks are awesome opportunity. And then you talk about the housing crisis and the lack of affordable housing, and you're going, these mobile home parks are going to be even more in demand because there's no affordable housing in a lot of desirable places. Let me actually give the details of the article / podcast. It's called Mobile Home Parked on Planet Money on NPR.
It's cool. I'll check it out. Now I'm gonna reach into the fishbowl and pull out something with regard to the search for yield. A lot that's coming out right now is saying that yield is going to be, with regard to bonds, with regard to just returns on stocks, right, decreasing over time because we've had such a boom. In that world, and tying to something we've talked about a good amount, you have to watch, well, in any world, but especially in that world, you have to watch the amount you're paying in fees.
Yeah.
Yep. Right. And so there's this Wall Street Journal article that came out that's called "Say Goodbye to the 1% Investment Advisor Fee." And what that's alluding to is basically, if you, maybe not even alluding, what's straight hit up on the noggin is, if you want someone to manage your money, then you got to pay them. And historically, a give or take 1% has been like the going rate for registered investment advisors, right? So,
yes.
Right. So if I'm investing $10,000, I say, Skippy, take my $10,000, bring me return. You're basically going to be like, all right, well, give me $100, right? Mm-hmm. And give me $100 a year. I'll manage it for you. That like might sound like nothing if you're making what people are expecting 17%, after inflation returns, right? If you're like, well, I'm bringing in 17 tendies, take one of them, like no big deal, right? However,
Tendies.
yeah, I know. I'm just throwing out language I don't even understand. But in that world, it might seem like nothing. But I threw out some numbers just so we can get like a sense for what 1% does over time, right? Because that's 1 year. If you go, instead of making 17%, I'm making 16%, whatever.
Yeah.
But here's some figures.
Well, Diggles, let me guess, because I haven't run these numbers in a while. It's as much as a third, like 30, 40 years later, 1% is as much as a third, a quarter of return.
Yeah, well, if you think about the power of compounding, you basically take the number of years and it's like a little more than that times 1%, right? I mean, effectively. So if you, let's say that you're doing this over 25 years, right? And I'm expecting a 5% return, but instead I get a 4% return, you're going to lose about 30%, right? If you will have 30% of your hard-earned.
I mean, that 1% takes 1/3 of your money. It's absolutely staggering.
If you go to 7% versus 6%, then we're talking about a little like 26%, a little over 25%. Now, if you look at the numbers that some folks are projecting over the coming decade or so, which is like 1.5%, like basically nothing, then you're effectively saying you're taking, like, they just take everything right away at that point, right?
Well, more than
yes.
If expected returns are like, say, barely positive or maybe negative, I mean, like, it
takes a lot. So the point of this is saying, if you look at these numbers, it's a big deal that's compounding over time, and folks that are getting, let's say, hundreds of thousands of dollars that they're giving to RIAs, registered investment advisors, you're paying so much money in order to. This article says the average investor with $750,000 paid 1.04% of investment assets in fees in 2020, which is up from 1.02% in 2015. Right. Yeah. The more money that you have to invest with someone, they'll lower rates. And so an investor with 10 million, it's saying paid 0.62%. Anyway, those are high numbers. And it was throwing out some alternatives. I'll name what the alternatives are, and then I just love to get your sense or your take on fees in general in this world, and also we can talk about hedge funds because I know that's come up a bit before.
Yeah.
So alternatives it's throwing out are flat annual fees. So don't charge me 1%. Just say, like, I'm gonna charge you $5,000 no matter how much you go up or down. Like, if you give me 1 million, that's not half as much work as 2 million. So I'll just take $5,000 from you.
Yep.
There's another world where it says we're going to charge you monthly or hourly fees. So kind of like a lawyer, right? Effectively, like I'm going to charge you based on the work that I do. And then the third one they threw out there was basically just lower fees. Like, just stop ripping people off and just charge lower fees, or what they threw out there. So
all right, I shall pause. Let me jump in. So my favorite guy in the space is James Osborne. He's local. He's from Lakewood, Colorado, basinasset.com. And if you go to his Twitter, the tweet pinned on top of his profile is the ridiculous nature of asset-based fees. He is obviously a fee-only asset advisor. He has an interview with Michael. I never know how to say I always say his name wrong. Michael Kleitz? No,
not the Godfather.
I'll put it on the Twitter because I butchered his name. Who is like the advisor to financial advisors and talks a lot about how to build a group. I'm with you in most cases that fee. So if one, I think getting quality financial advice can be incredibly important once you have a certain foundation and a certain net wealth. So I just say that. Two, I think asset-based fees are wrong for the majority of people, even though they're most common. I think fee only makes a lot of sense. Or my favorite is always performance-based fees. Performance-based fees are hard, and our regulations made it nearly impossible to implement unless you're an accredited investor, which creates all sorts of additional hoops. But my side tangent here.
Before you go on, though, would you explain what performance-based fees are?
If I manage your money and you lose money, or I make you 2%, I don't charge any fee whatsoever.
But both of those sound like plausible scenarios if you're managing my money. Continue.
Oh, please. So Buffett did this in an early partnership where returns less than 6%, he'd charge no fee. He didn't have any of those because he's Warren Buffett. And then he'd take a quarter of excess return over 6%. So if he made you 10%, he'd take 1%. If he made you 14%, he'd take 2%, all the way on up. Dougals, in the scenarios you just ran, you see how once you get above a certain threshold, taking fees out of that doesn't really kill you because you're making these incredible returns. So like if you make 12% a year, you're in good shape. And Buffett keeps 2%. I really think that's the model. I'll tell you why that's not the model. There's 1,000 reasons for this, but one, that sucks for the financial advisor, because when the financial advisor has a down year, their income completely disappears. Two, people argue that incentivizes financial advisors to take unwarranted risk, which I think if you can't trust your financial advisor to take unwarranted risk because you think they're going to go for a short-term gain, then you have the wrong financial advisor in the first place. I think we got two great articles from listeners this week. I want to start with one that came in from Kyle, who's really my boy. Kyle and I go way back. He sent over this article in the New York Times. This is one of those guys, if you're on the fence about paying for journalism, like this article to me was worth the cost of subscription to the New York Times for like 3 months because it's just really well done. It's by Connor Daughtry, who's based out of the Bay Area. It's called Where the Suburbs End, about California real estate. Douglas, you can make it through this one.
I did. Spit on it.
So I know you used to live in California. I'm curious for your initial reactions before I dive into the facts.
All I can say is when the mention of the unaffordable housing crisis, right, came up a bunch. When I was in San Francisco specifically, we rented our 750 square foot 2-bedroom apartment, couldn't afford to buy that, and wouldn't have bought it if we could afford to buy it. Like that's kind of like the summary. And this was years ago. And so on the other side of the pandemic, or the other side of the crisis, right, that was hitting the pandemic, I'm not sure where things are, but that about sums it up.
No, and that's kind of the background, right? It's, in my experience, it's like really educated with it folks often get priced out of communities that just, it seems crazy. It seems like there's a crazy disconnect. I have family over there who used to live in San Francisco, ended up moving all the way to Fresno to get a house and a yard that they think is, I know, right? That's like a 3-hour drive for those who don't know.
You got to do what you
got to do. Totally different community, totally different place. And that's happening all over the place. So Governor Newsom has been working on this, I don't know, for this conversation, let's call it a housing crisis, right? And the way they chose to solve it, or attempt to solve it, is with ADUs, which are basically backyard units that you can throw in any suburban backyard and make another house out of it. And there's a lot of arguments for. Some of it is mother-in-law suite, or, if the kids are ready to move out, but they can't afford, to your point, they can't afford $1 million home because they're in their early 20s or whatever. So they signed a state bill, I think it's called SB 9. Is that right, Douglas? SB 9, that sounds basically right. Statewide makes it legal to put backyard units in all suburban homes. So they kind of overrode the city ordinances that used to make this extremely more challenging and went for it. The interesting thing about this, potentially on a positive side, this has paved the way for some 2.5 million new housing units, which is about 25 years of the state's supply at current building pace. So they went from saying we're going to have struggles with building new homes, and it might not be solvable for decades, to going, hey, within the next 3 years, we can easily build and install and permit 25 years worth of inventory.
Wow.
Now, what comes with this is all the dynamics of, well, my suburban home, like I'm not in favor of that because it's going to change the dynamic. What about parking? What about infrastructure? What about everything else?
Yeah. And the personal, sorry to interrupt, but the personal stories they put in there around that, it was so well written. The way that really he weaved in the personal stories about the woman that like grew up in the house and now lives across the street and all that. It was really well written.
Yeah, I want to pull this quote. So housing politics is nonpartisan. The term NIMBY, which is NIMBY, is short for not in my backyard, right? Can't you relate to that? It's like, oh, I understand that there's an affordability crisis or a housing crisis. And if people outside of my neighborhood want to solve this, by all means. But when the politics shows up in my neighbor's backyard, and that means I have more cars parked on my street, like it becomes I don't care if I'm red or blue. I don't like change.
Yeah, people are NIMBY all over the place, right? It's kind of like the people that are, I'm all for higher taxes on the wealthy, all that. But but can you wait until after
taxes?
after?
Yeah,
you just hold up on that.
I love that. NIMBY everywhere. So let me give you a few more facts, and then if this is interesting, we can continue the debate. If not, we'll move on, right? So he specifically details a neighborhood called Claremont Village outside of San Diego, built in the 50s, right? When this was built, the median income to afford the $82 monthly payment was the very definition of middle class. Like, this is as middle class as it gets, right? Plumbers to doctors to, like, it's a diverse neighborhood. Today, those same homes cost about $850,000, which is up 30% just in the past 2 years. And you would have to make about double the median income in San Diego to afford one of those homes. So same neighborhood, not particularly like nice or mansions. The definition of middle class when it was built has now gone to something that's double the definition of middle class to afford the payment. And a lot of that speaks to the housing shortage in my eyes and what it's done to housing prices in California. But you see this other places in the States, right?
There was one thing, this is not what the article is about, but it was something that was traveling through my head as I was reading about this, is that 1950s housing boom, so the post-World War II like housing boom effectively that happened in the US, which was a lot of government sponsorship that went behind it, created an enormous amount of wealth from like home equity for people, for homeowners in the country.
Yeah.
Except it was largely targeted for the like white population of the US. And so what was going through my head as I was reading this is, from the perspectives that were in this article, like I fully understand it. And then I was also thinking that there's this double, maybe triple, quadruple whammy, quintuple, because I just keep going up, sextuple whammy that happens, which is there were the folks that were left out of that initial boom. Plus now you have the housing crisis. For these folks, there's NIMBY. And then for these other folks that are like, can I have a backyard? Kihimbi? Yeah. I don't know if I can. Too much.
That's way too much, but it's funny. Okay, so then, yeah, I hear you, right? And that's in a way happening today in terms of, if you're in a hot real estate market, you either have owned a home and you're riding that wave, or you haven't and you've just missed out, and it's terrible, and that's all associated to this supply crunch. Here's what's happening on the developer side that I think is interesting, then we'll put a bow on this. So they profile a guy that's been flipping homes in this environment, right? So he buys a home in that neighborhood. He pays $700K. It's the estimate that the current rental he could pull from that is a little over $3,000, which basically pays the mortgage, right? What he's going to do is spend an additional $400K building new units and splitting the house so it's set up to rent. And then he's going to command somewhere between $9,000 and $10,000 a month in rent, which makes the property worth the equivalent of $1.7 million, obviously increasing the population density on that lot by 3 to 4 times. So he now has a very easy way to turn this suburban family home into almost a rental complex and make, I mean, you do the quick math there, he should be up $600K if his math is right here, even if he wants to sell the thing, because he buys a home and he sells a rental unit of 4 properties. And again, I see both sides in terms of how that's better for the community and how that would absolutely drive the neighbors insane.
This is not a simple problem. Like it's really complex. The supply, if you abstract everything out, the supply situation in California is absolutely real. And so,
Yeah.
and I think what the government is basically saying is we're just focusing on that. Like that's a real thing. And there are going to be consequences from this, but we gotta settle that. But when you get down to the micro level, the neighborhood level, the NIMBY level, it feels real, right? Those emotions are legit and valid.
And this is the Patrick O'Shaughnessy pod. So some really quality content comes out of there. I know I've mentioned it in the past. This was basically about Philip and Bill's adventure with Second Life. And Dougals, I know you're very familiar, so I'll let you jump in shortly. But Philip founded Second Life. Dougals, I'll lean on you for the facts. I want to say 20 years ago. Really got hot in 99-ish. Is that right?
I was after that. So it was founded, and if I remember correctly, it was founded in 2003. And the 2006 to like 2008, 2009 era was really when it was hot, the hotness.
Thank you. So yeah, the 99 reference I made, actually, as I remember it, that's when Philip felt like the computing power was getting to the point where it could take this idea he had and turn it into something. And I think his idea was largely about, he loved Legos growing up, and he thought it'd be really cool if a bunch of people in real time could collaborate on like Lego sets that all link together, right? Super cool idea. And really cutting edge, I think, in the early 2000s. And there's a reason that this got popular. That a few factoids that I'll throw out that I just thought was super interesting. For those who don't know, Second Life is like the first iteration of what people are calling the metaverse today. And it's also probably an early iteration of like the Minecrafts that are incredibly popular right now. I think Minecraft is the first or second most popular video game in the world. The Roblox, which is a public company that has all sorts of buzz and has some really cool features. Second Life did this first. And so Patrick's view was, I'm going to talk to Philip and Bill about their adventures 15 years ago and see what's applicable to Zuckerberg's vision of the metaverse today. I just think it's a fascinating concept. If you're hearing that buzzword out, I'd encourage you to dig into this, because there were so many great learnings. So let me pause before I go down several more rabbit holes, Dougals, and let you jump in on the Second Life experience.
Sure thing. And I left Linden Lab, which is the company that makes Second Life. I left there about a decade ago. So anything that's happened there over the past 10 years, I don't know anything about. But the technology behind this is incredible. Like, I don't think I'll experience technology again in my career that was comparable to what was created there. To give you a sense early on, so Philip was at a company called Real Networks before he came to Second Life, and Real Networks was it was a media player online, and so that's where, when you bring up like seeing bandwidth being capable, computing power being capable of doing this, like he was in the heart of what bandwidth computer power looked like. But anyway, early on in Second Life, they created this thing called the rig. So this is before my time, at the very beginning. Created this thing called the rig, which was a chair that you'd sit on, and it would measure, like, you'd get all hooked up, and it would measure like your movement, your body movement, so you can move your avatar like through this chair, right?
Wow.
Yeah, I mean, it's phenomenal. Then drop that, end up going to a mouse and a keyboard, right? But because it's much more practical. But anyway, it was just showing you how far ahead the thought process and the like technological push was at this organization. But quite incredible. And happy to talk a little bit more as you start to get into the podcast. I'd love to hear what was interesting to you, and then I can feed in any experience I had there if applicable.
Yeah, well, so much, and I'm glad we have a expert with some experience at this actual company that we can lean on today in Dougals. But just really fascinating stuff. So they talked about total addressable market a little bit, right? He said initially they were kind of excited with, I'll probably articulate this the wrong way, but like the graphics, and they wanted it to be somewhat lifelike and stuff. And then when they compare and contrast to like the Minecrafts and the Roblox today that have taken off in a way that maybe Second Life never got to that in terms of number of daily active users and sort of things, they both said one of the things that Minecraft did right is make the learning curve to get immersed in that world as simple as possible. And you see that with 5-year-olds and 7-year-olds jumping into Minecraft head over heels. I think Second Life, and I'd be interested for your take on this, initially was like, this is a more adult-like thing, and they just realized that the niche for adults that, one, either have the free time or have the interest or have the desire to escape to this other world is a small percentage of all adults. I mean, people are out raising kids and going to soccer games and balancing their work stuff, right? So that was a really interesting insight that they said if they did it all over again, they'd make it as simple as possible, and they'd probably start with kids as your core market and maybe grow from there.
Yeah, and we talked a little bit about this before on the pod around kids, because to give you some sense for when I was there, I did a lot of leading on strategy, like corporate strategy for them, a bunch of other stuff. But one of the things that I kept tracking was the growth of virtual worlds around kids. And so I'd send these emails to like Philip, our CFO at the time, right? And then we had a CEO at one point, Mark Kingdon, great guy, and say like, we got to do this thing, right? And we actually had there were two separate Second Lives. There was the adult Second Life, and then there was a kids one, but the kids one was effectively neglected.
Okay.
We didn't do as much there. It was like a tiny part of things. And I was saying like, this feels like it's a real thing. And then one day, Philip was like, he called me in, and I'd made this deck that I'd put in a drawer. I used to make decks and put them in drawers. It was like a thing I did early in my career. Do that if you want, young kids. Anyway, so I pulled out this deck and like showed what could the growth of kids be like. And Philip was like, go do this. And so we had this project that was like about 6 or 7 months long, where we looked into how can we have kids be in the same world as the adults, because them being separate, it wouldn't work. And so I was like, how do we redo our marketplace? And so we did this whole thing, and kids grew from like 1% to 20% of our audience nearly overnight. Like it became a pretty big thing, but it wasn't built for kids. I think to the point of what he brought this up in the pod is that we didn't have the simplicity, right? That like kids could really get into. So we ended up making it was 16 plus. So it wasn't like kids. It was 16 plus that we ended up making it. But yeah, but I fully, as he was talking there, he and Bill were talking about that. It like took me back like fully into those moments when we were discussing, but trip down memory lane.
No, it's so fun. I really enjoyed this one because, I mean, I think Bill Gurley is like the most rational venture capitalist that I'm aware of. I'm always taken by like his expertise, but his groundedness, and you know, he just comes across as trustworthy to me, and that's not always the case with those types of folks. I really enjoyed this, but to me, the overarching thing, without going down too many rabbit holes, was kind of like, they are directly saying that Zuckerberg's vision for the metaverse is misguided. I don't know. What's the right word, Douglas? Like, they don't appear to be excited about his ideas for how the metaverse will work, about his thoughts of the total addressable market, about his ideas about profitability. Like, to me, the two most knowledgeable people in the world on the subject, basically, I mean, they'd be in that a handful of 10 most knowledgeable people on the metaverse, are going, no, the Zuckerberg's approach doesn't make any sense. And that's how I felt from the start. Like, that's the worst part of the Facebook investment right now from an equity perspective, is the fact that they want to spend however many billions on the metaverse. And I just think it's a dead end. Anyway, what were your takes on that compare and contrast of their learnings to Zuckerberg's approach? And maybe not just Zuckerberg. There's a lot of people talking about the metaverse right now.
Yeah, but in general, yeah. So going back to your point around Bill Gurley, rational, he is, and also pushes the envelope, like rational and pushes the envelope. Philip is not rational, like, which I think makes like a really interesting pairing. And what I mean by that is, like, back in early 2000s, he's thinking about rigging people to chairs, right? Like it's like he's living in a whole different universe. So it's an interesting like pairing as far as the podcast goes. To your point,
I mean, it's a creator mindset. It's awesome.
Exactly.
Like, you need those type of people. Yeah,
exactly. Part of what they brought up in the pod, and it's true, is that like they did this, right? Like the what, when I say did this, I mean what Zuckerberg's talking about around, I think exactly what one of Bill Gurley, I'll get the quote a little bit wrong, but in the spot he said, he's like, no one wants to have a board meeting in the metaverse. Like we had board meetings in the metaverse, right?
Yeah.
And then there was a
and the board members said we're not going back to that. That was not a good experience for us. Like we've been there, done that.
Exactly, because it's a useless use of the technology, basically, because you log in, you get in your avatar, and you go sit in a chair, and then it's just audio, right? Like that isn't then it just becomes a conference call. And so that's not the use for it. There are other elements that you can use for business and education, which Philip also talked about, around building out 3-dimensional representations of things in the real life, and you can experience them together. Like that's a use for it. But like if Mark Zuckerberg or at all like ends up going down the same path effectively that Second Life with the enterprise went down, then you're not using the learning that other folks have had. So if you just kind of go in there and you hang out with other people from your company, like that's not going to be it at all. But there's a there, but you got to get it right. And if people have already gone down that path, I hope Zuckerberg's trying to meet with Philip and Bill and Mitch Kapoor, who is the earliest investor there and on the board. Like learn from the past, and there's stuff to do.
I just like, if you're at all fascinated, it's the best thing. I feel like I've consumed 5 different podcasts that somehow talk about the metaverse, and this was by far the most rational, most meaty. There's so many good learnings and appropriate facts in there. Like Second Life is still around. I think user base is about what it was sometime in the late 2000s, Dougals, and there's still, I forget the numbers, but I think billions of dollars being exchanged in that marketplace. They talked about creating the marketplace, and that was just fascinating to me. I mean, they basically could have had crypto long before crypto. Now, it wouldn't have been decentralized on a blockchain, but they made a decision early on about if it was going to be pegged to the dollar or if there was going to be a fixed amount of the fixed supply of the currency, which could have completely changed the outcome of that game, because people could have started buying Linden dollars. As the user base grew, they would have increased in values relative to the dollar, which could have brought more users to the space. There's just a lot of fascinating decisions that were made. I really enjoyed the pod, and so I'd recommend it for sure.
Definitely, if you're into the metaverse, listen to this podcast. And I'd also, if you're going to read anything about Second Life, to pull a thread that you just said, read about the economy. I think that is the most fascinating part about Second Life, is the economy, the Linden dollar as the quote unquote cryptocurrency. That's not what we called it there, but the digital currency. Yeah. The economy is so fascinating, and the exchange that we had. So like, if you can find old articles or anything about that, I would go and read about that. It's really fascinating. The original NFTs,
really
baby.
Good. Yeah, really good stuff. I'll check that out.